Hi everyone, welcome to Coffee and Conversation with List Self Storage. My name is Allison DeJager and I'm the Director of Marketing and Communications for List Self Storage. As you may know, List Self Storage is a platform for buying, selling, and financing self-storage, conversion, and development property listings nationwide. To date, we have represented over $3 billion in self-storage assets for sale, and we continue to add new properties daily. We are so pleased to have launched a pre-recorded video chat series, Coffee and Conversation. Coffee and Conversation is a place where self-storage professionals can openly discuss common questions and concerns during the acquisition process. Each session will focus on different aspects of buying and selling properties available to the self-storage industry and will be yours to view anytime from anywhere. Today's presentation will last approximately 30 minutes. If you have any questions following the video chat, please email them to Allison, A-L-I-S-O-N, @listselfstorage.com. Today's topic is the self-storage financing and feasibility studies, what you need to know. Today we are joined by Terry Campbell of Live Oak Bank and Jim Chiswell of Chiswell & Associates. Terry joined Live Oak Bank with over 20 years of experience in the self-storage industry. He leads their self-storage division. And Terry, how many years have you been with Live Oak?
Just about 3 years now. March the 2nd will be 3 years.
Congratulations to them and you. And then Jim has worked with countless self-storage owners and managers, coaching them through numerous issues and problems that develop in the normal course of day-to-day operations. Jim, can you tell me a little bit about what that entails?
Well, Allison and Terry, glad to be here this morning or this afternoon, depending on when you might be watching it. Chiswell & Associates was started in 1990, but I've been involved in the industry now for 37 years. I started at Sovereign, then was called Uncle Bob's, now called Life Storage. But at the time, we were a private company, and while I was there, we built and acquired 35 stores in 10 states. I managed that portfolio, and then in July of 1990, started my own firm. So it's been since 1990, I've worked exclusively in the storage industry, and it's watched its evolution.
That's great. So I think it's safe to assume that between Terry and Jim, we're in pretty good hands today. Let's go ahead and get started. Jim, you've been conducting self-storage feasibility studies for 35 years. So what do you feel are the primary areas of research to consider when doing feasibility research?
Before we jump in, I have to comment on something that happened in 2017 that affects the gentleman that's sitting here with us. Terry joined Live Oak Bank, which is a bank that many people probably have never heard of. Some of the people who are tuning in today may have never heard of Live Oak until they started looking at self-storage. Well, in 2017, Live Oak, using the SBA 7A program, became the #1 SBA lender in America. Now, this is a bank with no branches. Oh, and they did about $627 million in loans for SBA's 7A program. And the second bank behind them, was maybe somebody you've heard of, was Wells Fargo, who has 6,000 branches across the country. So Terry, congratulations to Live Oak, not only your team, but the entire team there. It's quite an accomplishment for the little bank that could. So I couldn't resist getting that plug in there because it's such a miraculous accomplishment in my opinion.
Thank you, Jim.
Absolutely. Way to go, Terry.
Thanks.
From the standpoint of feasibilities, which I've been doing again for a long time, obviously one of the things that's impacted us today is the level of growth of competition. I mean, I can still remember I have a dear friend in San Diego. When he built his first facility, his nearest competitor was 300 miles away. Now he has 35 facilities within 3 miles. So that's what's happened to our industry. And so as I talk with clients across the country, and I've worked in 49 of the 50 states, my wife still can't understand why Hawaii is a state we haven't worked in yet. But I'm working on changing that. But is an understanding there's a lot of homework that has to go into it. Before you even have a chance to pick up the phone, send an email to Terry or a member of his team, for example, you better have done your homework. You better have looked at not only the site, but the competition, the demographics, what's the trend of that demographics. I had a conversation with a gentleman the other day and I said, are you aware that in the 3-mile radius, about a 10-minute drive time from his site, that the average household income is $34,000 a year and dropping. The trend line was that it would continue to decline. So he was looking at going into a market where the majority of the people are living at a very subsistence level. Now, if you look at the 2017 National Self-Storage Association demand study, you'll see that, in fact, we've got about a percentage of people that no matter what their income, they're using storage. And the average household, almost 40-some% of our customers from this research are making $50,000 a year or less. So it isn't that you have to be in an area that's just, oh, I've got to think of, oh, they all, that's not true. But you have to have a balance in there. And I see people ignoring that demographics many times as they get so excited about wanting to get in the storage industry and finding a piece of land that's properly zoned, in many cases, is not in the most desirable area.
Great, thank you. The self-storage industry is coming off a second near record-setting year in terms of facility development. So what do you think that means in terms of the competitive environment new developers should consider?
I missed the last part of your question. I'm sorry.
Oh, no. Just with the record-setting year in development, what do you think that means in terms of the competitive environment for new developers?
No, I mean, it's gotten, the competitive environment, as Terry knows from his work across the country, because honestly, he's been contributing to that additional competition, is it's now 8, 9 square foot per person. When the National Self-Storage Association back in 2003 started to undertake the demand study work, they listened to the guy who, in my opinion, is still the preeminent assessor of self-storage, and that's a gentleman by the name of Roy Wilson. And Ray's contention was it wasn't population that drove residential demand, it was households. And so when I calculate demand, looking at it, I look at it both ways. Both the traditional way some people say is so many square feet per person versus how many square feet per household. Terry and I can both remember being at a conference in Las Vegas when we discovered that there was 1 square feet of storage for every person in that market in the county, and we thought, oh my God, the world's going to come to an end. Development there is over. It's probably now, I'm guessing, 11, 12 square feet per person there because of the rapid use of storage. So the understanding the dynamics of the competition, and part of that too is what's the quality. There are 2 aspects of it. One is qualitative and the other is quantitative. I can tell you how many square feet of storage space is in a given market area, but what's the quality of that storage? Is it 20 to 30 years old? It has no office, it has no security, it has no temperature controlled units, it has none of the amenities that today's customers are looking for. Well, that may mean that there's still a market opportunity there. We've worked with clients in many markets where mathematically you'd say, well, there's no demand here. Yet when you look at the qualitative side of it and you realize how poor, that they're run down, that they're older, that they're not being properly maintained, they're not being properly managed, there are no temperature controlled units available in that target market area, yet there's enough economics in terms of the dynamics of the households to want it, then you say, okay, there is an opportunity to build an all climate, in many cases, all temperature controlled facility, which transcends the mathematical formula that you'd say, oh, gee, you can't build it there.
I kind of want to jump into that just a little bit more. So the SSA said that there's enough space across the country where every American could actually stand underneath a self-storage roof. Just want to know, like, what demographic factors you would consider when examining a site, and like what in the early stages, what aspects of site selection should be the primary focus.
Well, we've been blessed as an industry where if you go back and look at our roots and you track that at the same time with the growth of the size of the average household in America, you'll discover that back in the early days, in the 50s, 60s, that the average person in America was living in a house that was about 950 square feet. Today, that average unit size is approaching, or in many markets over, 2,000 square feet. So there's been this quantum shift in the amount of space that Americans are living in. Yet during that time, where we went from a 900 square foot average household size to a 2,000 square foot average household size, we created an industry that last year did about $30 billion in revenue. So it's contrarian in many regards about why storage has been successful. Our national research shows that better than 50% of the people who are using storage have an attic, a basement, or a garage. That's why, in fact, Terry and I talked about it the other day. Green Street Advisors, one of the major financial industry research firms, made this huge deal a couple months ago about the fact that autonomously driven cars are going to totally dramatically change and negatively impact self-storage. Because since I can get an autonomous Uber car to come to my house to pick me up to the grocery store, that somehow America's love affair with the automobile is going to end, and that, oh, therefore we're going to have empty garage space, therefore people are going to store at their home now, and self-storage is going to collapse. And it's laughable. Number one, the technology is not going to advance that fast, in my opinion. Not in my lifetime, not in the lifetime of my children, and maybe even my grandchildren. But the fact that you're going to run counter to what is, I think, a core value within America, and that is the sense of freedom that if I want, I can go out, get in my car, and go somewhere. And so I think that their comments about how technology is going to undercut self-storage, I think was totally off base.
I agree. And also, we love stuff. If I've got the space, I'm going to get more stuff.
An old friend of mine coined this phrase doing an interview many years ago in Las Vegas with a local TV station. He says, at its core, what we're doing is storing people's memories. And that's true. I mean, the couch that was sitting in my fraternity house, which no longer exists, is sitting in storage somewhere because one of my fraternity brothers won't give it up. Okay, and his wife, of course, refuses to have it in their house.
That's understandable.
But Terry and I have both seen the Barbie doll collections, the barbed wire collections, all kinds of crazy things. And the other thing that self-storage has never really gotten the credit I think it's due is we've incubated as an industry literally millions of small businesses where people were working out of their houses and their neighbors were complaining because Roadway Truck or FedEx or whatever constantly was there delivering products and samples and whatever. And now they get a free employee by storing at my facility because I'm willing to receive their package and put it in their unit or save it for them in the office so they can come and get it at their convenience. We've never gotten the credit as an industry for what we've done for small businesses.
That's really interesting. I'm going to jump around just a little bit. Terry, how has the SBA loan program grown over the past few years? And how have SBA-specific lenders helped self-storage owners have access to capital?
Well, first I'll give you just a little history lesson about the SBA. The SBA started actually in 1953, but it took 57 years before self-storage became eligible. It was October of 2010 whenever self-storage did become eligible for that program, and it was great timing because that was during the worst part of the recession as far as building. I was with a building supplier for 20 years, a building manufacturer, and nobody could get money during the recession. So when this announcement came out, we were all pretty happy. Hey, we're going to be able to sell some of these buildings. We've been doing a lot of quoting. A lot of folks want to build, a lot of folks want to expand, but they couldn't because they couldn't get money. When this announcement came out, we were all very excited. But kind of what happened is the program got a black eye right off the bat. And the reason is because most banks do not understand the SBA program. I kind of like to compare it with, you wouldn't hire your podiatrist to do a heart valve replacement just because he's a doctor. Just because a bank is a bank and they have the ability or authority to do an SBA loan, if they don't know it and don't understand it, it's not going to end well most of the time. And it's not a bad program. It's just you got to work with someone who's experienced with it and knows how it works. As far as how the SBA program has helped self-storage owners access capital, I can only really talk to our experience and what we do. You know, we have helped in many ways in the fact that we have experience in the industry, a lot of experience. Like I said, I had 20 years before I came here as a building manufacturer and also as an owner. So we bring a lot of experience. We bring a lot of different perspective than a lot of other banks are going to bring to it. Our process here, and again, we are now we are the #1 SBA lender in the country as far as dollar volume as a bank. So we know the program, we know the process. We have an easy online portal process that makes it easy and very streamlined for the borrower. So you're not dealing with mountains of paperwork. It's online. There's not a lot of redundancy. It saves time, and people like it. And we get a lot of good comments about that. But not only things like that is with our experience, we can direct people to resources. We insist on a feasibility study, for example. So when we have folks, it's like Jim, we can send folks to Jim. Hey, you need a feasibility study. Hey, give Jim a call here. For example, I always like to say, if you deal with a bank that doesn't require a feasibility study or says that you don't need one, you need to run. You need to go the other way because that is not, from our perspective, the way you need to look at this. Feasibility study is not an expense. It's an investment to make sure you're going to do this right. I've seen deals over the years where folks wouldn't pay a few $1,000s for a feasibility study, and then it went to auction a couple of years later because they built it in the wrong place. This is something that I am extremely passionate about. Is that you got to have a good feasibility study that's going to help guide you in the right direction on that project. Other things, other resources we can bring to the table, other than folks like Jim that do a feasibility study. We'll ask the customer, are you familiar with cost segregation? If you're not, here's what it is and what it can do for you. And here's someone that we can send you to work with that. That can really help you with your cash flow the first few years of your business when you're trying to lease up and ramp up and you need that cash flow. That can help you. We can help with other resources, general contractors. What about specialized websites, SEO placement, building suppliers, etc. So we bring a lot to the table, and in addition to just our experience in the SBA and our abilities there and the speed in which we operate is the resources we can bring to the table and our expertise. The long answer to your question.
Allison, I want to jump in with a live story, okay? Terry and I were with a client of mine in New York, and we're meeting at the site, and it's a classic kind of a construction thing where we've got a set of plans on the hood of the trunk of a car, and Terry is talking with probably one of the older, and he'd get mad at me for saying that, but experienced architects in the self-storage industry in the Northeast. And as they're talking about it, Terry made a suggestion about a reorientation of something in the building. And the architect said to me later, he says, Jim, I've been doing this for a long time. And I said, yeah, Frank, I know. He said, I've never had a banker in my entire life tell me something that was intelligent about the site until I met Terry. He says his comments totally changed how we're going to approach the project. And it did. So, I mean, it just, well, but that's the level of experience that Terry and the team bring to the equation. That's like, when somebody says to me, well, boy, you've been in the industry a long time. I go, yeah, and I know where a lot of the landmines are, and I know where some of the bodies are buried. And there's so many simple things that people can do as they talk to their lender. I mean, one of the things, and Terry knows this, is to start to talk to them early, to explain, where you're headed. You don't just walk in with this huge bank package and jam it down the throat of your lender. Okay, you do it by establishing a relationship. I mean, I know that a lot of the clients that I have that have used Live Oak for their loans, okay, have always commented to me about how people have looked out for them. We had an unfortunate situation where, as Terry will recall, we had a site where the contractor installed the insulation in the roof system wrong. And yet Terry stepped up on behalf of the borrower, okay, and insisted, no, you're going to make it right before anybody gets paid. And his leverage of being in that position, understanding the process, understanding what had to happen, saved those people from what would have been years and years of heartache, in my opinion, okay? Probably a lawsuit, but it's because he and his team understand the process and are willing to stand behind their borrowers. In this case, again, with a building company that should have known better, but just lacked the proper supervision when the job was done. But Terry stepped up, and I really admire that in the way that he has led his team and how Live Oak's approached the lending process in the self-storage business. That's why they lead the pack, because they get it.
That's very cool. Terry, that's awesome.
Well, thanks for that, Jim. By the way, Jim, did you tell the architect that he's not supposed to call me a banker?
Yeah, I know. I did.
Yeah,
That's a running, Allison, it's a running joke between us.
Okay.
Jim tells people not to call me a banker. I'm a self-storage guy that works at a bank.
All right. Noted. With regard to industry trends, what do you see occurring right now? And then what about, what do you project in the next 5 years?
The industry trends, what I'm seeing actually a lot of, I mean, you know, it's not really a trend anymore. It's becoming more normal, is multi-stories, more boat and RV. But one of the newer things that I'm seeing a lot of is unmanned facilities, where they're either using a kiosk or it's just some other type of technology, be it a website, a loan. But we're seeing more of that, and we financed a few of those this year. I mean, when you know, your taxes, property taxes, and your management costs are your two highest costs, as Jim will tell you. If you can reduce one of those, it can really help make a deal work better or work at all, especially on a smaller deal.
Yeah, I mean, the technology, as an industry, we've been slow adapters to some of the technology, but now it's roaring across the country, and I have a lot of clients who are using a hub and spoke, where they have a central location, and then they'll have it without the technology to try and run a location of 5,000 or 10,000 square feet. You can't do it because there's no way you can afford to have someone on the site. And yet, between having a central location, the call centers today, because right now, Insomniac, one of the leading kiosk companies in the nation, when you walk up to it, there's a proximity sensor, because all my information is in the cloud. As you walk up, they know, oh, welcome to Jim's Bins, how can I help you? They know all the information, whether they be a customer or a prospective customer, and the kiosk allows you to scan the person's driver's license, actually have them sign for their lease, have them go over the rental agreement. That comes to them electronically. They get a code to get in the gate. It dispenses a lock. So, I mean, it's just miraculous today. And between, again, as Terry mentioned, the ability to rent and pay online is also added another dimension to trying to limit that big expense, which is payroll. But and this is old school of me, okay? Nothing replaces that handshake, nothing. And so people it's a misnomer that you can totally eliminate payroll. You've got to have somebody there, because you're going to have somebody call you at 8 o'clock at night who tailgated somebody in and then can't get out because they don't remember their code. And so, you know, who deals with those kinds of issues? So there's still a human dimension to it, but certainly, as Terry said, what's happened technology-wise has opened the opportunities to a whole lot of other new development that otherwise you couldn't afford to operate.
Absolutely. With regard to people new to the industry, do you think an SBA loan would be right for them?
Well, it may be. It depends on their background, what kind of business plan they have, what kind of equity they have. That's always a one-on-one conversation we like to have with everybody, because some people who think they don't qualify could qualify, and it could be a good loan, whether they're new or even folks who've been around for decades. There are folks in this industry that have been around decades that I never would have thought that an SBA loan would necessarily be the right thing for them, but we work with them.
Okay. Well,
I've also,
sorry,
Allison, I've had a few people who have said to me, "Oh, we want to do an SBA loan," and I go, "Yeah, your estimated net worth is close to $1 billion. I don't think you're going to qualify. I think you might have too many assets."
So what would be the main differences between a conventional and SBA loan?
The main differences between an SBA and conventional is going to be equity is a big one. The amount of money, I mean, the different terms for equity, down payment, skin in the game, whatever. We can do as little as 10%. If cash flow allows it, we can do as little as 10%, where a lot of conventional lenders want 25 to 35. You know, we hear a lot of different numbers, but most of them that we hear tend to fall in the 25 to 35 range. I've heard as little as 20. I've heard as much as 40. So it varies, but sort of that is a big difference. That can also help folks to do a project by themselves instead of trying to raise extra equity, private equity, or having partners. That's a big deal. Financial covenants, there are no financial covenants with the SBA loan. Well, I take that back. There's one. You pay your payment every month. That's the only one. You don't have debt service coverage ratio covenants. You don't have loan to value covenants. You don't have some of these things that cost people their businesses during the recession due to no fault of their own. No balloons, so you don't have to do a refi. There's several great reasons. It doesn't fit everybody, but we love to go over these things and explain the differences, in one-by-one cases so people understand, because so many people still don't understand the loan program or the process or how it works, or that can benefit them.
And the other thing that, and Terry, when Terry said about the program getting a black eye, it's because if you have people who don't understand the process, and all of a sudden what should be a relatively short approval process, and well, we've got to do this and we've got to have SBA look at that, and all of a sudden the person's 4, 5, 6 months before they know one way or the other. And I've heard that, and I say, it's because the person you're talking to doesn't have a clue. And that's the truth.
Great. So that the core of any self-storage financial performance is its unit mix. Is there a secret formula for designing a unit mix for a new project?
Is that to me?
Well, either one.
Go ahead, Terry. You can start.
Well, as a unit mix, it needs to be a unit mix that it's been derived from a feasibility study that tells what that market needs. Does it need climate, non-climate? Does it need a certain size? One thing you don't want to do is what we used to call banker's mix and use all 5x10s, because you get more rent per square foot for a 10x10. That used to be something they used to do in the early days. They would build these with a lot of small units, but you can't fill them up. So they sit there empty. That's another, and I can give you another quick example of how we and our experience in this industry have helped folks. We had someone who bought one of those type projects, had a lot of empty 5x10 units. So when I went with one of my loan officers to go do the site visit, and we do a site visit, we visit every borrower face to face, and we visit every location, whether it's an acquisition, new construction, conversion, whatever. But when we were there doing the site visit, I looked and I was able to say, okay, you've got all of these 5x10 units. You look right here, you can take this mullion out, you can pull this wall down, this is not load bearing, and able to show them a unit mix, how they could revise and change up that unit mix and update it to something that fits the market. So they were able to do that, change their mix, and maximize the site as far as sales and what they can rent.
And those are the opportunities too, in terms of if you're doing an acquisition, to look at, have they missed the market with, is the reason why they've got the vacancy levels they do is because they've missed the market? And as Terry said, we have the ability to change that. The other thing that I see is when you put a unit mix in and it drives the revenue. Yes, you have some incidental, you're going to sell some boxes, locks, you're going to have an administrative fee, you're going to maybe sell tenant insurance and derive some revenue from that. But it's really the unit mix which is the core of how you make your business. I see an imbalance going on in many cases with that temperature controlled versus standard unit. I've got people right now that I'm working with their first plan called for no climate control, no temperature control units at all, yet they're in a market where the average temperature in the summer is 85, 90 degrees. So they're missing the market opportunity. But when you have an Excel spreadsheet, it's real easy to do what if, what if, what if. And as Terry said, okay, all of a sudden you can take a facility of, say, 60,000 square feet, and if you, instead of an average unit size of 112, 115 square feet, you run it down to 85 or 89 square feet, all of a sudden the financials, they explode, and you go, oh my, this is what I want to do. No, it isn't, because as Terry said, if they sit and they're empty. The other problem that I see too in design today, as it relates to unit mix, is people are making the assumption of how fast they're going to lease it up. Yeah, I've made mistakes. I have a client in South Carolina who built a very large facility. It's 4 stories. I told him it would take 36 months to fill it up. Extra Space happens to be managing it for him, and they filled it in 11 months. And all I can say is, God bless you, okay? I'd rather be wrong that way than I tell you you're going to lease up in 6 months, and 18 months later you're still at 40% occupancy, because, and as Terry has seen firsthand, unfortunately, we have a lot of borrowers who look at it and say, if I make the assumption I'm going to lease up in 6 months instead of 18, the amount of working capital that I'm going to set aside to pay for my negative cash flow during that lease up period is going to run out. And what do I do? Well, do I go back to my investors? Do I try and get another loan? Do I whatever? Okay. But we've seen all too often where you're using your unit mix and you're over projecting how fast you're going to lease up. You run out of working capital, and that's a nightmare. And so the other part of that, in terms of not having enough working capital, is people have to understand, if I'm building a self-storage facility, I can do 2 things. I can bring it in on schedule and on budget, but I'm not making any money. It's only when I start renting units. And I've been telling clients for years, the day you get your building permit, you should have a website up. The day you get a building permit, the sign should go up, coming soon, with a website address on your property. The marketing has to start the day you start to build, which is when you get your building permit. Because I've seen people wait. Building today in America has become a very, very tough thing to do. I don't care where you are, even in Texas, which for years they had the reputation it was easy. Building in America has gotten tough. It is. It's an uphill battle, fighting with the bureaucracy that is at the communities, the building inspectors, and all the various code changes that we've seen affecting our industry. But if you just focus on building it and you don't start thinking about the marketing of it, all of a sudden you're 30 or 40 days away from getting your certificate of occupancy. That's not when you start marketing the facility. You have to think about it from the very beginning. And that's one of the things that I see in terms of people missing the mark as they look at their unit mix, who they're going to market it to. Because if you have a classic case, and Terry's seen this too, you're in a college town and the guy is doing his market research in August. Oh, every small unit's filled, so I'm going to have a lot of small units. You don't go back in September when all the kids have gone back to school and their vacancy is now 40% because all their small units are empty. And it happens. So it's balancing that unit mix, understanding the marketplace, because 75 to 80% of your unit rentals are going to be to residential people coming from a 10-minute drive time. Self-storage is very, very micro-market specific. We're back to you, Allison.
All right. Well, actually, that's pretty much a good place to close. But do you guys have any final thoughts about what you see as the future of self-storage and what we're doing going forward?
Well, I think the industry still has legs. I think we're going to see still a lot of deliveries of projects that are in the pipeline now that are going to get delivered. But I honestly, I would not to be a damper, but I think there's a cautionary tale in that I see things will slow down. I see interest rates unfortunately headed up, and Terry can comment on that. But there's still unbelievable opportunities. Self-storage to me is still one of the greatest entrepreneurial opportunities in America. We have the lowest payroll to gross revenue ratio of any business you'll find. Of any business. I have one of my clients who's now on his 4th facility who happened to be primarily in the restaurant business. And he said, Jim, have you any idea if I have a restaurant doing $1.5 million worth of gross revenue, how many employees I have? And now I have storage facilities doing that, and I have 3 full-time equivalents. But be cautious, be wary, do your homework. If there's ever been a time when that has to be the marching order for anyone considering getting in the business for the first time, you gotta do your homework. And you gotta surround yourself with people like Terry, and hopefully even maybe you'll call on Jim Chiswell, okay? Or the folks like me across the country who have the experience, who have been in the trenches, who understand now's the time to be super cautious.
There's really nothing I can add to what Jim said. I agree with everything he said. And I just want to say, Allison, I appreciate you having me, and Jim, I appreciate you being on here as well for this webinar.
And I appreciate you guys so much for joining. Thank you.
Thank you for my mug.
Absolutely, yes. Yeah, thank you both so much. This is really great and very helpful. And thank you everyone for attending the 3rd installment of Coffee and Conversation. If you have any questions or comments, just email them to me, Allison, ALISON, @listselfstorage.com, or give me a call, 248-473-3755. Thanks.